NatWest made £2 billion in 3 months, and investors sold the stock. On the same day the results landed, Santander completed a £2.65 billion acquisition to expand deeper into the same UK consumer market NatWest just warned is heading towards stagflation. One bank is leaving money on the table, the other is writing a check for it. Thursday's session in London carried that tension throughout. The FTSE 100 closed up 1 point. Oil prices eased on fresh reports of Iran ceasefire talks. The FTSE 250 added 1.2%. For a few hours, the numbers looked almost normal, but beneath the surface, two of the session's most significant moves pointed in opposite directions at the same market. NatWest reported Q1 pre-tax profit of £2 billion, up from £1.8 billion a year earlier, beating analyst consensus for flat growth. Total income reached £4.4 billion, a 10% annual increase. The bank's net interest margin expanded to 2.47%, a 20 basis point gain. Mortgage balances grew £3.3 billion. Startup customer accounts surged 25%. By every headline metric, a clean beat. And yet shares fell nearly 4% on open to 563p. Hidden inside those results was the signal the market focused on. NatWest booked a £283 million impairment charge for the quarter. Almost half of it, £140 million, came from a reassessment of its economic forecast, directly attributable to the Iran war's impact on UK growth and inflation. The bank that just posted record profit simultaneously told investors it now sees a plausible path to stagflation. That is not a routine caveat, it is a formal change to internal credit modeling. Gilt markets had been sending the same warning all week. UK 30-year borrowing costs hit 5.79% on Tuesday, the highest since 1998, driven by the Iran war energy shock compounding political uncertainty ahead of Thursday's local elections. Labour lost control of at least 8 councils. Reform UK made gains across England. Keir Starmer vowed to remain as Prime Minister, and yields pulled back from their highs by Friday, but only to levels still elevated by historical standards. The BOE's 8-1 vote to hold at 3.75%, with chief economist Hugh Pill dissenting in favor of a hike to 4%, confirmed what the gilt market already knew. The next move in rates is more likely up than down. Meanwhile, fixed-rate mortgage rates have climbed back above 5%, and Rightmove data shows the average house price has slipped again. UK mortgage affordability is at its worst level since 2008. Into that backdrop, Santander announced its £2.65 billion acquisition of TSB was complete, making it the UK this week, right as NatWest was flagging that the consumer it just bought is facing the worst squeeze in a generation.
The market's reaction to NatWest was not irrational. It was a forward-looking read of what the bank's own numbers implied. Higher for longer rates are genuinely good for net interest margin in the short term. NatWest lifted its full-year income guidance to the top of its £17.6 billion range, precisely because rates staying elevated means fatter margins on existing loans. That is the profit engine running at full speed right now. The problem is what elevated rates are simultaneously doing to the asset side of the book. When NatWest set aside £140 million in credit impairments tied to the Iran war's economic fallout, it wasn't flagging a hypothetical. The bank was adjusting the probability weights on existing loan portfolios. Those £3.3 billion in new mortgage balances added this quarter were originated at the current market rates, above 5%. If the BOE hikes once or twice in the second half of the year, as Hugh Pill's dissent implies is on the table, those borrowers face immediate affordability pressure. High street foot traffic is already down 10% in the biggest single drop since COVID lockdowns. JD Sports flagged mooted growth. Weatherspoons warned again on profits. Next said it will raise prices by up to 8% on products sold outside Europe due to war-related cost increases. The consumer that backs NatWest's mortgage book is being squeezed from 3 directions: rising rates, rising prices, and falling real wages. Here is where the read becomes more complicated. The same higher for longer rate environment that threatens credit quality also caps how far the BOE can cut. If inflation stays elevated due to energy prices, oil was trading above $104 per barrel on Friday morning, the BOE cannot provide the relief valve of rate cuts even when defaults start rising. That is the stagflation scenario in concrete form, not an abstract label. Profit margins on lending go up while credit losses mount faster. The net interest margin expansion that made Q1 impressive could reverse sharply in Q3 or Q4 if the impairment cycle accelerates. That is also why the market sold the stock despite the beat. Investors are pricing not the $2 billion that arrived, but the quarter in which that £140 million impairment starts compounding. The 28-year gilt high was not background noise this week. It was the same signal NatWest embedded in its results, expressed in a different market.
Santander's timing looks either reckless or visionary, depending entirely on one variable, whether the BOE hikes again. The Spanish bank did not pay £2.65 billion for TSB's loan book. It paid for scale. TSB adds several million retail customers to Santander UK's existing base, vaulting the combined entity to third place in the market behind Lloyds and NatWest. At that scale, the cost per customer economics improve substantially. Shared infrastructure, combined mortgage origination capacity, unified digital platform. In a market where smaller players are being squeezed out by compliance costs and thin margins, scale has genuine defensive value. There is a historical precedent worth examining here. In 2008, Santander acquired Bradford and Bingley's retail deposit book and branches, again at a moment when UK consumer banking looked like a burning building. That acquisition, combined with the earlier purchase of Abbey National in 2004, made Santander one of the UK's largest mortgage lenders by the time the post-crisis recovery arrived. The bank that looked reckless in 2008 looked prescient by 2012. The parallel is not identical. The 2008 entry came at distressed asset prices after the banking system had already broken. This acquisition was priced at full market rate, £2.65 billion, before the worst of the potential impairment cycle has been confirmed. That matters because the upside case depends on Santander acquiring those customers at a point before credit losses crystallize, while the downside case is that it has bought a large consumer portfolio exactly when that portfolio begins deteriorating. The condition for the bear case is specific. If UK inflation stays above 3.5% into Q4, forcing the BOE to hike from 3.75% to 4.25% or beyond, mortgage arrears will rise in the second half of 2026. NatWest's £140 million impairment would look like a down payment. Santander's new customers, largely TSB's base, which skews toward first-time buyers and younger mortgage holders, would be among the most exposed cohort. The acquisition cost would be effectively higher than the headline number implies, because the inherited credit quality would need marking down. The condition for the bull case is also specific. If the Iran conflict produces a negotiated ceasefire before summer, oil drops back below $90, the BOE holds through year-end, and mortgage rates ease from their current 5% plus levels, Santander will have bought market share at a distressed sentiment price without distressed asset credit risk. That is the best possible outcome for the deal. The gap between those two scenarios is not wide in time. It may resolve by the Bank of England's August meeting. The verification point is the June gilt auction. If 30-year yields retest the 5.79% level or breach it, the market is saying the BOE has lost control of inflation expectations. NatWest shares would likely revisit their opening low. Santander's acquisition would be underwater on paper before the first full quarter closes. If yields instead settle below 5.4% and hold there, the week's dominant narrative that UK banking is a value trap will need to be reconsidered. The question is not whether UK banks can earn money in this environment. NatWest already proved they can. The question is whether the earnings survive the credit cycle that follows. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.